So imagine selling your pristine, top-of-the-line fire extinguisher just so you can pay an overdue water bill.
Right, yeah.
You are basically sacrificing your ultimate safety net simply because you desperately need the cash today. Welcome to the deep dive. We're looking at a stack of March 2026 market reports, and there is this massive paradox staring us right in the face.
There really is.
Yeah. Gold, which is, the ultimate financial safe haven,
Mm-hmm.
is suddenly crashing.
Yeah, the speed of the reversal is just staggering. I mean, just a couple of months ago, back in January, gold was hitting these record highs, peaking above $5,500 an ounce.
Oh, wow, yeah. And fast forward to March, and it has plummeted like 14 to 17%.
Exactly.
It broke right through key technical levels at 5,000, then 4,600, dipping all the way down into low 4,000s. I mean, we really haven't seen an aggressive pullback quite like this since the tightening cycle of the early 1980s.
It's been a minute.
Right. So, okay, let's unpack this.
Yeah.
Because with all the serious geopolitical chaos happening globally right now, you would think all that uncertainty should absolutely be pushing gold up.
You would certainly think so, but macroeconomic forces are basically overpowering that traditional safe haven narrative right now. The U.S. economy has remained surprisingly resilient.
Even with rising energy prices.
Exactly, even with those, which means the U.S. dollar is surging. And since gold is priced in U.S. dollars globally, a strong dollar directly crushes foreign demand.
Right, because a buyer in Europe or Asia
Yeah.
suddenly has to spend, much more of their local currency to buy the exact same ounce of gold.
Yeah, it essentially prices them out of the market.
Wow.
That currency dynamic alone is a massive headwind, but then you add the Federal Reserve anchoring into this higher for longer stance on interest rates.
Right, markets are giving up on those aggressive rate cuts.
Exactly, which pushes real yields higher.
And, for anyone wondering why real yields dictate gold, gold is a static asset. It doesn't pay a dividend.
No interest at all.
Right. So when a treasury bond suddenly guarantees a high return risk-free, holding on to a zero-yield asset like gold suddenly looks, well, very expensive. You are losing out on guaranteed income.
What's fascinating here is just how quickly that math changes investor behavior.
Oh, totally. Like a crowded theater, right?
Yeah. When those bond yields go up, institutional investors look at their portfolios, realize they can get a guaranteed return elsewhere, and they just abandon their gold positions.
That makes sense, especially considering the massive run gold had in 2025, jumping over 50%. I mean, investors borrowed heavily to ride that momentum.
Oh, absolutely. They were highly leveraged.
Right. But when the macro environment shifted with that strong dollar and higher rates, those borrowed positions became a huge liability. Brokers started issuing margin calls, basically demanding immediate cash to cover those loans.
Yeah, and to get that cash, they had to deleverage, frantically selling whatever they could.
But I have to push back here. If the financial system's so stressed out, why are investors selling their best insurance policy? Like, why sell the safe haven instead of your risky assets?
Well, that is the big plot twist of March 2026. Right now, gold isn't acting like a safe haven at all.
Really?
Yeah, it's acting like a highly liquid asset. It's essentially an ATM.
Oh, I get it. They are selling it just because it's the easiest thing to turn into cash.
Exactly. When stressed investors get hit with margin calls in other, less liquid parts of their portfolio, they desperately need to raise funds.
Right.
They sell the gold not because they've lost faith in its long-term value, but because it is one of the very few assets they can liquidate instantly without taking a massive haircut.
So gold is essentially taking the hit to keep the rest of the stressed-out financial system afloat.
Yeah, which is exactly why this matters to you listening. This behavior proves that the overarching bull market likely isn't over.
It's just a stress test.
Yes, a brutal repricing phase. But the long-term structural drivers, things like central banks hoarding gold and the broader global de-dollarisation trend, those are completely intact.
So it bounces back.
Forecasts actually predict gold moving back toward 5,000 and beyond later in 2026, once this liquidity squeeze finally passes.
So if you are looking at the March 2026 headlines and panicking, you really have to look beneath the surface.
Definitely.
This is a volatile transitional market, and it's showing us the raw plumbing of the financial system. We are seeing what really drives prices when liquidity just dries up.
Yeah, it strips away the traditional narratives completely and forces us to look at the pure mechanics of capital flow.
It really does. But it also leaves us with a pretty alarming thought to chew on.
What's that?
Well, If investors are actively liquidating their gold merely to cover margin calls and raise emergency cash, what happens to the global market when they finally run out of gold to sell?